morning. I hope everyone have seats. Yes, I think. Dear guests, I'm honored to welcome you to this meeting on behalf of KPMG and the Prime Ministry of Iceland. My name is Margaret Flores and I'm a partner at KPMG, and I will steer this meeting today. We're happy to see how many of you have been able to attend, and in addition, a great number of people are able to follow us online. Discussion on the development of monetary policy is important for the development of any economy, and that topic has gained more attention following the crisis in 2008. Sovereign money is as an alternative is an important part of that discussion. At KPMG, we believe it's important to support further development of this discussion in society. Therefore, we were quite happy when the Prime Ministry commissioned us to write the report we are publishing today and are lying on the tables in front of you under the title Money Issuance, Alternative Monetary Systems. The report it aims at summarizing the key points of alternative monetary systems and pull together important writing and discussion on the topic. We hope this stimulates and helps discussion on the matter, and therefore we approach this as an independent professionals without expressing any views or opinion on the system or opinion if Iceland should adopt such a system, first of modern nations. The Prime Ministry of Iceland commissioned the writing of the report and co-hosted this conference along with KPMG. Unfortunately, our Prime Minister wasn't able to attend today, but I'm quite honored to ask Benedikt Árnason, the Director of Economic Affairs at the Prime Ministry, to take the podium and deliver his opening remarks. Please welcome Benedikt Árnason.
Yes, ladies and gentlemen, the Prime Minister, Sigurður Ingi Jóhannsson, was unable to attend this meeting due to other commitments. And as this will be my first and probably the last 2 minutes as Prime Minister, I will have to make the most out of this. Well, Iceland has suffered for more than half a century from serious monetary problems, including inflation, hyperinflation, devaluation, an asset bubble, and ultimately the collapse of its banking sector in 2008. Other countries have certainly also faced severe monetary problems in the last few decades. Since 1970, bank crises have occurred 147 times in 114 countries, causing serious reductions in output. Despite its frequent failures, the banking system has remained essentially unchanged around the world. Various reforms proposals have been put forward, many of them promising, but none have been implemented. We need to understand the risks and drawbacks of the present system as well as potential benefits of alternative systems. In 2014, the Prime Minister of Iceland commissioned a report by Frosti Sigurjónsson, the chairman of the Economic and Trade Committee of Alþingi, on monetary reforms. The report was well received and attracted international awareness. The Prime Minister decided to endorse and continue this work, and here today a new report by KPMG on alternative monetary system is introduced. I would especially like to welcome Mr. Martin Wolf to Iceland, as he has followed closely the debate on alternative monetary systems over the years. I hope that this meeting and the report will serve as a useful source of information for the coming debate. Thank you.
Thank you, Benedikt. we at KPMG were approached by the Prime Minister, by the Prime Minister's office at the beginning of this year to review the international discussion and monetary system following Frosti Sigurjónsson's report on the matter last year. We feel that this subject deserves further attention and coverage, and therefore we felt that it was important also to explain in simplified terms the fundamentals of sovereign monetary systems, and therefore we have here Sigurjónsson from KPMG, which has taken part in preparing this report, and he will provide us with a short extract from the report. Sigurvin.
Thank you very much, Margaret. So, in the report, we commissioned to write for the Prime Minister's office. We cover the review of a trend in the political debate internationally on money creation, an overview of public discussions and key academic papers recently published on the subject. But as Margaret said, we start by covering the fundamentals of the current monetary system and compare those to the fundamentals of the sovereign money system. It should be noted here that the sovereign money system is not the only idea that has been proposed as an alternative system, but we use it here as an example. So if we start by taking a look at the current monetary system, we have essentially three types of money in circulations. And this is a representation conducted by the Bank of England 2014 in their monetary bulletin. And so we have on the liability side of the central bank reserves and noted coins, and then we have commercial banks issuing deposits, which is the third type of money in circulation, and which we use in everyday transactions and business, and that is 90% of the money supply over that in most countries. So if we consider the money issuance, the bulk of the money issuance in today's economy, it is done through bank lending. So when banks extend loans, they also issue new deposits on their liability side. This contradicts what many believe, and I quote again Bank of England. It has been a misconception that commercial banks intermediate funds when they provide loans. They are essentially just creating new deposits at the same time as they provide new loans. Another misconception is that the money supply is directly controlled by the central bank through reserve requirements. This is not the case, though commercial banks, they can't expand the money supply endlessly. They are restricted by capital requirements, liquidity requirements, as well as reserve requirements. And this is another misconception which is common according to the Bank of England. And these two facts, that the money supply is difficult to control it in today's society, and the fact it's a liability of a commercial bank, has been the two key reasons why we have those alternative ideas of monetary systems floating around. So contrasting this system with the sovereign money system being proposed by Joseph Hooper originally in 2000, and now Positive Money, for example, in UK has been very active promoting. We see that there is no money on the liability side of the commercial banks. Instead of that, we have electronic money on the liability side at the central bank, who is the issuer of those deposits. And also we note that converting deposits into physical notes and coins doesn't require the third party in that transaction, doesn't rely on other party to issue that type of money. So if we take a look at the money issuance into the sovereign money system, it essentially is a two-step process, not a one-step process as in today. When the banks create loans, they are creating money and also allocating it into circulation. If we assume the Monetary Policy Committee is deciding on issuing new money, that is a matter of implementation, how if it's going to be another committee or not. But it decides if it's going to circulate new money through state finances or through bank lending. And if it does so through state finances, it's simply as the state will receive the newly created money and circulate it through national budget. If it's going to decide to lend new money into circulation through banks, the banks receives the newly created money through lending and re-lend it into the real economy, to the customers. Considering the balance sheet effects, of course, the balance sheet of the central bank expands by the money created, and if we assume that the government is circulating new money, and household businesses receive in the end through labor, for example, as they work for extra expenditure of the government, and this essentially creates new equity with households and businesses. It doesn't matter if the government is raising expenditure, it's going to increase the revenue of households and businesses. If it's going to lower taxes, it's going to lower expenses of the households and businesses as well. And if it's going to repay government debt, it's going to create savings in terms of interest payments, which will give ground for increased expenditure or lowering taxes. The other option to lend newly created money into circulation involves the commercial banks, of course. So they will receive the newly created money and re-lend it into circulation to households and businesses. So they don't have household business, of course, it's not a new equity, it's a new liability of that sector. But considering this picture here, we see that the central bank has its option to lend it to circulation, this newly created money, which support their purpose as a lender of last resort, for example. If we take a look at the payment system under the current monetary system, it entails when a buyer transacts money to a seller of a good or service, it transfers deposits to the seller's bank account, and in parallel it transfers reserves to the same bank. So if it's too much money is transferred from one bank to another, it can run into liquidity problems, and we have seen that in today's economies, for example, with Northern Rock in the UK, in the US, with Washington Mutual, and in Iceland in the banking crisis. So this represents in a two-way really settlements. So each bank has to settle the deposits between themselves, and also they have to settle these reserves with the central bank. Contrasting it to how it will be done in the sovereign money system, it doesn't require a settlement between the banks with deposits, as the central bank is the issuer of those deposits. It's just a matter of changing the ownership of those deposits which are being transacted. it has a stark resemblance in today's economy in securities clearance, where a clearinghouse does exactly the same. It simply changes ownership of bonds and stocks, for example, through broker announcements after trade has been settled, for example, in a stock exchange. Now, turning to the political development of the coverage of money issuance, really, since 2008, we do a quick review of what has been happening in that area in the report. In 2010 and 2011, Congressman Dennis Kucinich introduced an act to evoke a full reserve system in the US. So we're not only talking about sovereign money here, we are talking about the alternatives idea of creating or issuing money by government or central banks as a rule, instead of the commercial banks executing that purpose. Then in 2012, we had the Icelandic Parliament. There was a parliamentary resolution proposing research on alternative systems. The British Parliament debated money creation for the first time in 170 years in 2014. Again, in the Icelandic Parliament, there was a resolution proposing research on alternative systems, which had not been voted on yet. In the Swiss government, received signatures in order to call for a referendum, and there will be a referendum on the subject in Switzerland in the coming years. The Dutch Parliament debated money creation this spring and adopted 2 motions to research the current and alternative systems. So it's going to be exciting what's going to come out of that. So these are the political events which have been evolving in the legislative process, really, since 2008. Considering notable publication, we do a quick review of publication, what discussions have been going on in the media, and also what has been on the agenda, in the media. So, for example, I have 3 points here. It's the central bank as a creator of electronic money has been in a bit focus. For example, with the Bank of England, who published a paper from 2 economists this summer, where they conclude that 30% issuance, 30% of GDP issuance of central bank digital currency would permanently raise GDP by as much as 3%, as a result in reduction in real interest rates, taxes, and monetary transaction costs. So it's a quite interesting conclusions. But you see that we are not covering the sovereign money system. This is like part of the systemic change that the sovereign money system entails. People's QE, which is the central bank issuing new money to finance government investments. Again, one option of the sovereign money system. There was a debate in the European Parliament in February 2016, and later this year, 80 members of the Parliament sent an open letter to Mario Draghi, the President of the European Central Bank, proposing people's QE and also helicopter money in order to counter current economic situation. And turning to helicopter money, it was anticipated, and helicopter money is really money just distributed directly to households and consumers, for example, through tax rebates or lowering taxes. And it was actually anticipated by many that the Bank of Japan might go down this road, and it caused some fluctuations in the financial markets this summer. Now we also cover key results of or conclusions of academic publications. In the report we cover 14 publications from 16 authors, and those include PhD theses, public papers from researchers at universities as well as institutions, for example, the International Monetary Fund. And the main conclusions are that the adoption of a system where money is created by central bank or governmental entity, it would result in a reduction in public and private debt levels. It was quite a stark conclusion, which was not contradicted by any publication, and also that it will enable lower inflation. However, there was more varying conclusions, for example, regarding bank liquidity, interest rates, the complexity of transitioning into an alternative system. So, and a lot of issues covered in the papers, which I urge you to read if you're interested in this. It's been growing quite fast, the attention on this in the academic field. We conclude with proposing some areas of further research. There is two main things needs to be considered. Firstly, the structure of and implementation of an alternative system. It has not been defined in detail how it should be structured. For example, regarding the payment system, what monetary policy would be conducted under alternative system, as well as how the process of transiting into an alternative system would be handled. And of course, there has to be a more thorough research in the field of what impact alternative system would have on public finances, financial markets, financial stability, as well as the real economy. So I really hope that the report will be of interest to you and more insight, and thank you.
Thank you, Sigurvin. I hope that we have been able to interest you in the report, so you will all go home and read it in bed tonight. The central bank plays a key role in applying monetary policy in any economy. The sovereign money concept argues that the central bank should play even a stronger role in all money issuance. Therefore, it's very interesting to hear the views of the governor of the Central Bank of Iceland. Please welcome Már Guðmundsson, who has been the governor of the Central Bank since August 2009 and is now serving his second 5-year of appointment. Már, the floor is yours.
So, Chair, ladies and gentlemen, let me thank the Prime Minister's office and the KPMG for organizing this meeting and inviting me to speak here. I think that I became a central bank governor because I am very deeply interested in monetary economics. So I welcome very much that we have a deep discussion of the fundamentals of monetary economics and monetary policy. And I would like to thank Frosty and others for the initiative that they have taken in this discussion. But having said that, a lot of what I'm going to say is going to be critical. That doesn't mean that I do not value the contribution that they have been making to this important discussion. Now, it is very important to understand the risks that are inherent in fractional banking, but it's also important to understand the potential benefits and weigh them together. Equally, if we are going to design new systems, because Benedict mentioned that we need to study the potential benefits of new systems. Yes, indeed, but we also need to understand the potential risks of new systems. So we do not have a lot of unintended consequences down the road. Now, but to my mind, as will transpire in my comments, I think the focus that we have here on the more the narrow monetary control problem is too narrow, because many of the proposals that have come forward in terms of reforming fractional banking or abandoning fractional banking are not mostly motivated by that, but more by financial stability considerations, more by this attempt to build a financial system that is not runnable in some sense. I will come back to that. And to my mind, as I will explain, I think that is a more important focus. Now, I will, in my remarks, also discuss what we have done here in Iceland in order to make our financial system more safe. I said in my speech during this year's annual general meeting that we have been dealing with stabilizing the Icelandic economy, recovering the economy, dealing with the legacy issues, and now we are in the process of lifting capital controls. And it was my view, as I expressed then, that now when we have done all of that, so we have a few months left, then our attention should turn to what kind of financial system do we need and what kind of a financial system can we have. Now, so I said it is important to understand the risks in fractional banking and in banking and the banks as we know them. Now, that is partly explained in the publications that you have in front of you and in Frost's pamphlet, in a lot of things that I have written. But the bottom line is, banks as we know them are pretty useful, but they are also very dangerous. Now, what do they do? Basically, what matters here is that they provide liquidity to both depositors and borrowers. They specialize in screening and monitoring borrowers and thus mitigate the information problems inherent in many forms of financial transactions. But in doing this, banks engage in a maturity transformation, basically, and that is the basic reason that the banks are dangerous. They engage in what Mervyn King calls alchemy. They take a deposit from someone and say, you can have it back tomorrow, and then they turn around and here it is, you can have it for 10 years for your project. Now, up to a degree, this is pretty useful because that is the basis for both the liquidity services that they provide, and in some sense this will result in a more dynamic economic system. This ability to kind of gather small pockets of savings and make them into large buckets of savings, and this ability to engage in this maturity transformation is in some sense useful. But it is at the same time very, very risky because if everybody wants their money back, the bank is gone. And then in addition, because of these banks take deposits from ordinary people and how we have constructed our system, they have embedded in them important parts of the payment system, as a matter of fact, the part of the financial infrastructure of society. So that is why. How have we mitigated this risk? Yes, what we have done, we have built a safety net, lender of last resort, deposit insurance in order to reduce the risk of runs. And because of that, we need to regulate these banks in order to reduce moral hazard, because if you have a safety net or nothing else, you will have a tendency to take too much risk. And then, because of that, we need supervision to see to it that the regulations are adhered to, etc. So this is of course very simple, and all of this meeting here is very simple. We are discussing very fundamental issues. We should really take 3 days in the central bank in a round table where nobody can escape until they have fully explained what they are saying, because not everything makes sense that I'm hearing here. Now, we have, of course, an alternative solution to this problem, and that is to ban maturity transformation completely from taking place. So, at least in banks that provide demand deposits and form part of the payment system. And that is what ideas about narrow banking are basically about. And that is nothing new. We have had ideas on narrow banking in the 19th century, and always after every financial crisis they come up. And the basic idea is to split the banking system into 2 parts, neither of which would be subject to runs, according to the theory. So there would be narrow banks providing deposits as safe as central bank liabilities, and then we would have, basically, we might call them banks, but they will basically be mutual funds or investment companies where the ultimate investor bears directly and immediately all risk. So fixed nominal liabilities would not exist in that part of the banking system. Now, these proposals are worth studying, and I have to say myself, I have on occasions been weak towards going somewhat in that direction. And as I will explain to you later on, the Icelandic banking system is much closer now to a narrow banking system than it was before the crisis in various ways. But it raises many critical questions that we need to discuss, and we don't need 20 pages, we need 1,000 pages and thorough research. So, a question are like, what is the optimal level of maturity transformation in a banking system? Is it 0? I'm not convinced that it is 0. And secondly, would the system be truly safe from runs? So, in order to do that, you need to stop entry of runnable shadow banks into the second part of the banking system. I'm not sure it would be, they would be, and there are many academics, Neil Wallets, others, recently Steve Sissetti and Schoenfeld and others that claim that it would not. But anyhow, that needs to be studied. And who would then provide the intermediation function in this system and do the lending? Because after all, okay, it's fine if you have narrow banks that are not the central bank, then there is some scope for getting some rate of return on the deposits in the narrow bank, but very limited. But if it is the central bank, as some forms of sovereign money is some form of that proposal seem to be suggesting, then what we seem to be talking about is to a very significant degree nationalization of the function of lending and intermediation. And now I have great belief in the ability of central bankers. I am one of them. But what we are not in this business, and we would have to build it from scratch. This is what banks specialize in, or should be specializing in, or some kind of other institutions that are called the same. And the final question is, what would be the price in terms of loss of liquidity services and economic dynamism? Because after all, this elasticity in the current form of the banking system that the proponents of sovereign money and others seem to have so much problem with, is also beneficial. Because, and it is in some sense part of the function of banks to create money up to a point as a part of the lending function, and that is not a problem. Because as I will come to in a minute, the central bank has other, and in some sense, maybe better ways to deliver what monetary policy is supposed to deliver. Now, we have, after the crisis, we have had several proposals regarding how to deal with the problems that were revealed in the banking system. And I think the good thing about the sovereign money proposal or proposals like John Kay saying it is not enough what we have done, we need to look at the structure, the incentives, the culture, and the ethics in the financial sectors, or even the recent proposal by Mervyn King of a pawnbroker for all season, is that yes, we had this great financial crisis, but we have had many such crises. So there is something fundamental in the financial sector that we need to deal with, not which goes deeper than what we have done so far. So it seems to me that we have 4 proposals after the crisis. One is the mainstream proposal, what is being implemented at the moment. We are in midstream. That is to make the current system more safe, but basically keep the current system. That is Basel III, capital, liquidity, leverage of funding ratios, etc., a new resolution framework, which will make it possible, or is intended to make it possible, for banks to go into resolution without the payment system going down, having some kind of a re-fencing of the utility elements in the system, etc., etc. Then we have what I talked about the structure. We have the radical structural proposals, number 3, the narrow banking, sovereign banking, etc. And then we have hybrids of various type, and Mervyn King with the pawnbroker all seasons, which is basically because the sovereign money proposal, the narrow banking proposal, is basically 100% reserve requirement in the central bank against demand deposits. Whereas he is proposing that the banks post collateral with the central bank, and you calculate a haircut on that collateral that takes into consideration some kind of average condition, not crisis conditions in terms of pricing, and then that amount has to be equal to demand deposits or total deposits, which will amount to not 100% reserve requirement, but something less. Now, so I tend to think that when we dealt with the financial crisis, first we had crisis management and all kinds of things needed to be done to keep the system from totally melting down. And what was done went in some sense against what you need to do in the long run. Now we are going down this path of implementing the mainstream. But I think myself that we need also to look at the structure, incentives, culture, and ethics. It's not easy, but I am not convinced of going all the way to narrow banking or sovereign banking. And I think that Mervyn King's proposals or similar are also worth studying. Now, if I look at what we has been proposed here, it is a form of narrow banking, but the motivation seems to be more to fix an alleged monetary control problem rather than to deal with a financial stability problem. So the money creation through lending in banks seems almost to be morally wrong and has to stop. Now, some elements in these proposals are unclear, and there are, I think, exaggerated claims about the benefits. So, for instance, how extensive is the nationalization of the lending function? It is not fully clear to me. How to stop the expansion of vulnerable shadow banks? There seems to be some proposal of monetary financing on government expenditure. That makes me very uneasy being a central bank governor, because monetary financing of the government is usually the main cause of runaway inflation. And what is also critically lacking is the open economy aspect is not discussed. You saw there was these sectors, but there was the very important sector missing. It was the rest of the world. And that is, of course, very crucial in Iceland's case. And there is a question, how does this fit Iceland membership in the European Economic Area? It's also a question about the alleged debt reduction, which seems to be linked to proposals that deposits are not booked as liabilities in an narrow bank, in this case the central bank, and I found it hard to see how that can work. But as I say, some elements might be clarified in the course of the meeting. I'm looking forward to that and further discussion. Now, a few words about this. So, is it a monetary control problem or a financial stability problem that we should be focusing on? It's clear that majority transformation that was not backed by sufficient capital and liquidity buffers and the associated frameworks that comes with that was certainly a very significant part of the accumulation of risk that led to the crisis, and we need to deal with that. But to my mind, it was mainly a financial stability problem, not a monetary control problem. I mean, you look at, this was a crisis in some people say it was a North Atlantic financial crisis. It was in the centers, in the US, in Europe, etc. I mean, there was no fundamental monetary management problem, no problem with inflation. We have that now, but not at that time. Iceland faced a problem with monetary management prior to the crisis, but that had to do with capital flows and foreign currency lending, which is not covered in these proposals. Not with maturity transformation and mismatch in domestic currency. And these problems could easily resurface as we lift capital controls. And that is something we need to look at. And more generally, money creation of banks through lending in domestic currency does not pose a significant problem for monetary policy. Central banks can still shape monetary conditions through interest rate setting, reserve requirements, and quantitative measures. This affects money demand, which we have to remember here, and the profitability of money creation by banks. And central banks have chosen interest rates as their main instrument, and there are very good reasons for that, because the relationship between the money stock and the things that we care for, inflation, etc., has tended to be unstable. And it is easier to calibrate an interest rate rule than a quantitative money rule. Nobody is really doing that. Doesn't change the fact that when the central bank set interest rates, that affects money demand, and then there are other rules and regulations that affect the profitability of the money creation by banks, And when the target is hit in terms of inflation, there will be a path of the money stock that is associated to that and consistent with that. We don't know a priori what it is, but there will be. And therefore, I think it would be a step back to go into kind of what seems to be proposed here, a very fine-tuned monetary control, money stock control steering of monetary policy. It is like just legislating the quantity theory of money. That is, of course, debated among economists. Now, I want to say a few words about what we have done in Iceland, because it is not correct to say that there have been small changes here. There have been very, very fundamental changes. The banking system that we have in Iceland is totally different from the banking system that we had before. Because the old banking system has been replaced by a much smaller, simpler, and domestically oriented bank that have high levels of capital and domestic liquidity. These banks face strict regulations on FX funding and FX liquidity that almost eliminate maturity mismatch in FX, which we had to do because we had no safety net to back that down. But we still have this capital flow problem, and which has both monetary control implications and financial stability implications at the same time. And our solution has been to take that straight on rather than to make complex changes to the structure of the banking system with unforeseen consequences. We have a liquidity cover ratio and net stable funding ratio in FX. We have a regulation on currency mismatches. We are thinking to introduce strict limitations on foreign currency lending to unhedged parties. And finally, we have introduced a capital flow management mechanism in form of special reserves that make it possible for us to have an additional instrument that will affect capital inflows. Now, I have slides here somewhere on what I'm supposed to do. I'm going to show you one slide. Okay. This is my only slide. Just to illustrate how big these changes are. Here you see the funding structure of the three largest banks before the crisis and now, and you see also the size of the banking system because the size of the bars, this is basically the liability side, will indicate the size. And you see the huge shrinkage. You see that ISK deposit from customers is now the bulk of the financing, and then you have equity. That is basically how these banks are financed. Whereas prior to that, they were financed to a very significant degree by foreign currency borrowing and foreign currency deposit. And you see that here. This yellow here, borrowings, and 32% deposits, this is all in FX. Only 21% of the financing of the banks was ISK liabilities and equity, and it is 79% now. So these banks are also, they are simple, they all have the same business model, but they are not really connected. Now, finally, I would like to ask the question, how do we take this discussion forward? And I need to say that I think that Iceland is in the early stages of this discussion. The examination that will take place in the central bank, where we will lock you in for a week, is still to be done. And we will look at everything in detail, and no nonsense will be accepted. But so that is going to be done. And I think that the focus has to be broader than here when we have that discussion, than to focus on this particular proposal that originates mostly from the UK's positive money. And to my mind, not necessarily the best narrow banking proposal, and it's partly based on a misunderstanding in my mind about the nature of money in modern economies. Now, final comment this. Yes, we can a priori do all these studies about the potential benefits and risk, but proof of the pudding is in the eating. So it would be very good to have a natural experiment. Somebody would either sovereign money or narrow banking, whatever, do this, and we'll see how it goes. Some people have suggested that Iceland does this. I don't think that is a good idea. And there is Iceland is too small, it's too specific, and people say that it's not representative. And secondly, we don't have the freedoms to do that, because we are in a European Economic Area. And that really shapes the legislation on banking. But now we have a great opportunity, because the UK has decided to leave the European Union and probably the single market in banking. So the UK should introduce this system, and we have Martin Wolf here, but there are others. And we will follow that very closely and see how it goes. Thank you.
Thank you, Mark. It was very interesting. Our next speaker has been vocal about alternative monetary systems in recent years. Martin Wolf is the chief economic commentator at the Financial Times in London and highly respected in the field. He has been, amongst others, been a Forum Fellow at the annual meeting of the World Economic Forum in Davos since 1999 and a member of its International Media Council since 2006. He was a member of the UK Government Independence Commission on Banking in 2010 and 11, and his most recent publications are Why Globalization Works and Fixing Global Finance. Martin, the floor is yours.
So first of all, it's a pleasure to be here. My second visit to Iceland. Like the last one, unfortunately, a flying visit, in one day out the next, which is ridiculous. My wife knows Iceland rather better than I do and tells me I should spend a week here, but I don't have a week, unfortunately, and she wasn't prepared to come with me, which would have made it much more pleasurable. I don't like being a tourist of my own anymore. So I'm afraid it'll have to be the next visit. You can invite me again. It's a great pleasure to be here on the discussion of this very important issue. I commend KPMG for the report and the Prime Minister's Office for its interest in this issue, which is clearly immensely important. It's also an immense pleasure, but slightly double-edged, to follow the Governor's excellent presentation, because it would have been very useful to me in preparing what I was going to say if I'd known what he was going to say. Because to some extent it goes over similar grounds, and to some extent, and there are some points he makes which I had not intended to cover, and since I have limited time, we will probably have to deal with those in the subsequent discussion. My interest in this is pretty obvious. We have had very recently an absolutely colossal financial crisis in the Western world. As somebody mentioned, we have had something like 150 banking crises in the last 30 years. So it's pretty clear this is a system that has not become more stable over time. Generally, if you think about the management of our world in the developed world, I don't want to go into great detail, if you think about the management of diseases, the management of the public sector, the levels of prosperity and so forth, by and large, things have got better. But in my view, the financial system quite clearly has not. And we continue to suffer from the same frailties as the banking system, but in my view, on a bigger scale because their balance sheets have got much bigger relative to our economies, as we did in the 19th and early 20th century. We made essentially no improvement. One of the most important points of many in Reinhardt and Rogoff's book is that while we seem to have made some real progress in controlling inflation and dealing with fiscal crises by improving rules, the propensity to banking crisis has not diminished in any way at all. And on some dimensions, depending on the reference period, has got much, much worse, with the most obvious reference period being the post-war period, when for about 30 years we didn't suffer from this. And in addition to that problem, it seems to me very, very hard to argue that the financial sector has been doing a very good job at its fundamental business of intermediating finance for the benefit of the real economy. There's a lot of evidence that as the financial sector has got bigger, its contributions to productivity growth, the allocation of resources across economies and across time has deteriorated. And I think it has had very perverse effects in addition on the distribution of income. So it's not clear what we are buying for all this instability. So I suppose my big starting point difference, I think almost everything the governor is saying is sensible and wise, but my starting point difference is that this system is an unspeakable mess and it's going to go on being an unspeakable mess. So we should be thinking, so we should at least entertain seriously radical alternatives. And we shouldn't start off with the complacent assumption that everything is fine. So that's my introductory response. I actually agree with him that it will take weeks of very serious work to go through all the difficulties of proposals. There are an immense number of them now, with many varieties, and there are also very considerable difficulties with all alternatives, including this one. But we should not assume that the status quo, even the reform status quo which he described, is an ideal benchmark against which all other systems must be judged wanting. So what I want to do in the 27 minutes or so I've got left is cover 6 issues. The discussion is very far from complete, probably because in part I don't have time, and in part because there are issues on which I haven't yet fully made up my own mind. My general view in this area is that anyone who is absolutely certain they know how the monetary and financial systems should work hasn't thought hard enough about the problem. But I would make one final little comment on what the governor said. He emphasizes that the problem before the crisis was not monetary control but financial stability. And I would disagree with this way of putting it, because it seems to me the core problem of the system is that because the financial system is also the monetary system, these two things cannot be separated. They go together. And indeed, the whole story of the pre-crisis period, and I put this in my lengthy book, The Shifts and the Shocks, is that the policies designed to achieve adequate monetary control, that is to say low inflation, stable and low inflation, destabilized the financial system, or permitted the destabilization of the financial system. And so they cannot be separated. And that is the core of our financial system, because it is both the financial and monetary system at one and the same time. So I'm going to cover why the existing monetary system is flawed, why the standard reform proposals, some of which the governor talked about, are likely to fail, why sovereign money is a proposal that makes sense, how one might create sovereign money, and fifth, why sovereign money certainly has some very big problems. There's no question, and some of them we can discuss. And then I'm going to discuss some possible ways forward. So, why is the existing monetary system flawed? Well, the existing monetary system essentially relies on the private creation of debt-backed money by competing financial institutions. I don't think there's any question that's how it works. And over time, the private creation of debt-backed money has come to dominate other forms of money, either government-created money or, of course, coinage, which was the dominant form of money some centuries ago. Not surprisingly, a system of this kind is highly unstable. In boom times, there is a natural tendency of profit-seeking private institutions to create excessive credit and money that generates huge asset price bubbles, which are of course self-validating. It makes the lending they're doing look profitable and sensible. Of course it does, because the asset prices that they're lending in support of go up, so everybody is doing very well. And these asset price bubbles lead to grossly misallocated investment, which is an important real cost of an asset price bubble. Surely in Iceland one knows this. In the bust, which follows the boom, this very same system leads to panics as people realize that their debt-backed money is not as safe as they thought it would be. The private banks come to be on the verge of or over the brink of collapse, and then contracting money and credit. And the last financial crisis was a superlative example on probably the biggest scale in the history of the world of exactly what I have described. Many people don't, I think, fully understand, but I'm pretty convinced that this was the most severe financial crisis that, as far as I can see, has ever occurred. Of course, its economic consequences were mitigated by sensible central bank monetary policy, but though they were mitigated, they could, of course, not be eliminated, and the costs have been very large, very, very large. Now, the history of capitalism has been a history of monetary and financial crises of the type, and they always go together because the system is both a monetary and financial system. And as somebody has pointed out, there have been approximately 150 in the last 3 decades. And the frequency and severity, as I've already mentioned, has not diminished over time. The problem is as big now as it ever was. The reason for the instability is an inconsistency between what the public wants money to be and what the private profit-seeking, debt-backed system can provide. Here I rely very much on Gary Gordon's, Yale's, fundamental insight, which influenced me a great deal in my thinking about money in the last decade, which is, what does the public want money to be? What is the most important thing that the monetary holdings you have, I'm not going to talk about unit of account, that you want to be. And the answer is very, very simple and very, very obvious. You want your money to be the one thing that is absolutely safe and reliable when everything else goes to hell. That is to say, you want to be sure you can go out and buy the goods and services you need to run your lives, whatever happens. And if that doesn't happen, the society collapses, modern society collapses. Simple and good. This is not a completely theoretical point, because I remember very, very well, just before the IMF World Bank meetings of 2008 in October, that one or two of my friends who were very close to the financial sector, very, very close and very influential players, told me that they had themselves and advised their spouses to withdraw as much money from their banks as they possibly could, because the bank money was likely the following day to cease to exist. And may I quote in addition, because it's very remarkable, that at exactly this time there was a very famous meeting to discuss the TARP proposals, in one of whose participants was Ben Bernanke, and he was talking with Hank Paulson to the Speaker of the House, and in the US, and she asked what would happen if they didn't agree with these proposals. This was a Sunday. What will happen tomorrow to the US economy? And Ben Bernanke said, well, what happens if you don't agree with these proposals is that on Monday the US economy, and I'm quoting Ben Bernanke, will not exist. So this is what money is for. It is obvious, if you think about it for approximately half a second, that the private sector cannot provide this, since doubts about the values of the monetary liabilities of private financial institutions are precisely what causes the panic, which make people doubt the value of the money that they have in these banks. So by definition, the most important quality of money this system cannot provide. It cannot provide it on its own. And so in practice, the government must provide the required security, and that is why over the last 2 centuries, including notably in the UK at the very height of its laissez-faire policies in the early 19th century, the Bank of England emerged as the lender of last resort of the system, an issue that was already widely discussed in the United Kingdom in the early 19th century. But this has gone well beyond that. Not only does it act as lender of last resort, but because of solvency concerns about banks, the Treasury has also been driven to provide capital and guarantees to ensure the credible solvency of private banks in a crisis. Thus, banks are by definition semi-public institutions, and the guarantee of the moneyness, that is to say their role as money, which I have described, of the liabilities of private institutions is an essential government function, and it is, of course, as the Governor has already mentioned, a gigantic source of moral hazard in the entire capitalist system, because the core financial institutions are not private, they are semi-public, and there is absolutely no way to get away from this fundamental reality. And that's what the crisis showed us, again, with not only the biggest financial crisis, but as Andy Haldane and many others have pointed out, the biggest rescue of the financial system, again, in the history of the world. The way I tend to put it is that in 2008, essentially the entire, and I mean entire balance sheet of the governments of the major countries of the Western world was put behind the financial system. Have they been grateful? Hell, have they? So the standard official response, and it is because I am aware of this, I think, pretty major set of scandals that it seems to me we should be thinking very seriously about radical reforms. Now, the standard official responses have, as has been pointed out, been to introduce perfectly sensible ways of making the existing system less dangerous and less irresponsible. So tighter regulation of the solvency of banks, capital requirements have been increased. If you look at it from an unleveraged point of view, I think risk weighting is for the birds. I can discuss that separately. The equity requirements of banks have been roughly tripled since the crisis, but as I like to note, it's from nothing to almost nothing. That is to say, from leverage of 40 or 50 to 1 to leverage of about 20 to 1. The major banks of the Western world are leveraged in the ratio of 20 to 25 to 1. That depends a lot on the precise definitions of their assets and liabilities. Derivatives are very complicated, but this is roughly the picture. So these remain incredibly highly leveraged institutions. If they weren't banks, and they weren't so big, and they weren't so important, and if they weren't guaranteed by the government, nobody in their right mind would put money in them. I mean, it seems to me quite obvious. And when I put my money in my bank, I consider myself, and have always considered myself, to be lending to the government. Always. And anyone who doesn't, I think, just doesn't understand the situation. And they've also introduced tighter regulation of the liquidity of banks through liquidity requirements. But this, of course, these proposals cannot eliminate the instability. They might reduce the probabilities of it, since the alchemy, as Mervyn King as has been noted, has described it, beautiful word, of credit and maturity mismatches, is also, of course, the source of the profitability of the lending of the banks. The profit model depends on the very things that make it unstable. That's so obvious and has already been stressed by the governor. A second official approach is macroprudential policy. It's a way to deal with the instability of the system as a whole. It is a way to protect the financial sector from the cycle and the cycle from the financial sector. But in my view, macroprudential policy is also going to be very, very difficult to operate. And the interventions made to adjust the degree of risk in the system will be very difficult to judge in real time. Just look at the history of the last crisis, where people really didn't understand the risks before they bashed them. One of my favorite data, which appeared in the Independent Commission on Banking report, is that on the favorite risk-weighted measures used in accordance with Basel Basel I and II. Before the crisis, the British banks reported in the summer of 2007, just about the time of the crisis was going to hit, the highest level of capitalization of their banks that they had ever done. So the banks were absolutely rock solid according to the approved regulatory system of judging capital at precisely the point that they were about to collapse. That makes it rather difficult to feel confident that we know what we're doing where we are making our interventions. When the government, when the central banks using macroprudential policy decide to tighten monetary policy, to tighten financial conditions, raise equity requirements in the middle of a boom, they're going to be very politically unpopular. Everybody will say, well, there's not much risk here, everything is fine, we haven't had any bust for 20 years, and you're stopping our people from buying houses. And by the way, I mention that specifically because the main financial activity of modern banks in the Western world is facilitating the buying of houses. So that will be politically unpopular. Macroprudential policy is very likely to conflict with monetary policy in complex ways, precisely because, as the governor said, the aim of monetary policy is to stabilize inflation, and the aim of financial policy is to protect the financial system from the consequences, but the financial system is also the principal instrument through which monetary policy works. So they are going to be in conflict. It may have unintended consequences, and above all, and it is worth noting it, that if you take macroprudential policy seriously, it means that the riskiness of the system as a whole will be managed by the official sector, not the financiers. And that's exactly what's happening in the UK today. So in what sense can you describe this in any serious way as a privately run financial system? Not only does the government underpin the risks, it is also managing systemically the risks. This is a part of the state. It's not a private system. And so I don't believe in macro-pru. I think it will create very large problems, and particularly in good times when pressures to relax regulation is always strongest. 10 years from now, 15 years from now, macro-pru in the UK will be dead, in my guess. Another official response has been resolution authority, aimed at making it credible that a bank's shareholders and creditors will not be bailed out during a crisis. But this would not eliminate the possibility of crises and might well increase their likelihood. First, the no bailout principle with resolution as alternative is time inconsistent, and creditors know it. For this reason, risks will be taken, making crises more damaging and so a bailout more likely. To put it bluntly, if the crisis is big enough, they know they're going to be bailed out. So the important thing, as Keynes famously noted, is for them all to make the same mistake at the same time. As long as they all make the same mistakes, when it gets into a mess, they'll all go down together and they will be rescued. The important thing for a bank to do is to do something different from everybody else. Then they can be allowed to go down. Second, resolution might itself cause serious. I know that I'm sounding a bit frivolous, but I mean all this quite seriously. Second, resolution might itself cause serious crises, particularly if it damaged vulnerable creditors, insurance companies, for example. Yet another response with which I've been closely associated is structural reform, again mentioned by the governor, for example, ring-fencing of retail banking as in the UK. I do think this will strengthen the system by withdrawing the implicit subsidy to investment banking at least, but the retail bank can easily fail during the crisis that follows a huge credit boom, and that's exactly what happened in Ireland. It was the retail banks that collapsed in the crisis and imploded the economy. There are many more radical proposals than these. I've just gone through the conventional ones. One is a really radical deleveraging of the economy and the banks, associated particularly with the work of Marty and Helwig, which I greatly admire. And essentially, they propose that systemic financial institutions' leverage should be reduced from 20 to 1 to something like 3 to 1. Now, the important thing about such a proposal is that the political obstacles to such ideas are quite as huge as those to radical monetary reform. They would involve really quite as profound a shift in the nature of the financial system. And so it's not at all clear that they would be easier to implement. There are some very interesting hybrid ideas, as mentioned. Mervyn King's is a semi-narrow banking idea, which I'm actually rather tempted by, but I don't have time to go into those in detail. But I think the key point I wanted to make and wanted to leave you with is that there is a very, very, very powerful set of reasons for believing the status quo is intolerable. And that should start. The status quo should not be given the pass that the status quo is inclined to get, because it looks to me to be a wasteful and crisis-prone system, and current reforms won't solve it. So that leads me then to why sovereign money makes sense. That's my third section. So I've discussed the problem and whether we have sensible solutions already on the table. Well, let's start from the obvious facts that I have already described. The monetary system is a social creation and it is essentially a public good. That's why the government is so involved with it. It's non-excludable and non-rival as a system. We all benefit from the existence of a functioning monetary system. Handing the private sector, the whole monetary system over to private entities creates huge problems. Indeed, as I pointed out, it cannot be handed over in full to private entities, since the latter cannot ensure monetary stability, as we all know. So publicly backed money is in conflict with the private profit motive. We could move to a system in which the government creates money in part or in whole, instead of guaranteeing privately created money. And that's essentially what we will be doing with sovereign money proposals. Government-created money would reclaim the seigniorage in the system and create a more stable financial system. It could limit the ability of the private financial system to extract rent and, in the process, generate inequality. And I don't have time to go through this, but if you think about the process of the financial system as it actually operates today, banks lend against property collateral, they leverage up and enhance the value of the latter. Banks earn fees and interest in return for creating the money that makes this possible. These fees and interest are then turned into income for employees and shareholders, and under competition, this income is then partly competed away and ends up as excess leverage in the system. And that seems to me precisely how the current monetary and financial systems operate. It's not surprising that economic benefits are very small. In a crisis, so that's the general point about creating sovereign money. In a crisis, there's a special point which Adair Turner particularly emphasizes the attractions of sovereign money in a crisis. Central banks in a crisis can create money and hand it over to the citizens, or to the government to hand over to the citizens in many ways, even if there were no agreement on the permanent government monopoly of money creation. Therefore, the option of a sovereign money system in crisis, which is exactly what we got, but we call it QE, exists, and it could be much more effective if it's done in the way that I describe, I think, than today's form of quantitative easing. The problem with QE essentially is that it works via the financial system. But after a crisis, the financial system is by definition dysfunctional. So QE is a fairly ineffective and slow-burning policy. And I believe that direct monetary injections, the immediate impact of which comes via spending by the government, and therefore it, of course, has the characteristics of fiscal policy, will be more effective. The fourth question, so that's briefly what I think the benefits of sovereign money would be, both as a long-term system and a short-run system. How might you create sovereign money? There are four avenues that I can think of at the moment. There might well be more. One is, as was already mentioned, 100% reserve banking, in which banks continue to provide services to customers. Money is created by the central bank on behalf of the governments. Banks can only back their deposits. Short-term liabilities, we could discuss what short-term in this context means. That would be a matter of legal definition, against central bank money. All other aspects of the system remain as they are. The second possibility, which I think is the positive money proposal, is that government creates the money, in which banks will be agents for accounts containing government money. A third possibility, which some of my friends rather like, is that the monetary accounts of households will be at the central bank. The central bank becomes a payment mechanism, and then there would be no run, because everybody knows central bank money is money. And the final possibility, which is now becoming increasingly plausible, is central bank digital money outside the banking system in a wallet of some kind, or some sort of distributed ledger. These various alternative mechanisms are significant technologically and bureaucratically, but it seems to me the economic differences are unimportant. Under all of them, money creation will be transferred to the state. The scale of possible monetary creation depends on how much of the existing stock of financial liabilities will be considered money. And I think it's a crucial point, which I think the government suggested, and goes back into the whole history of the debate on finance, Gurley and Shaw and so forth in the 50s, is that what money is not difficult to define. It's not easy to define, it's difficult to define. So there would have to be some definition on what is and what is not money. And that would be a very important issue. But you could well imagine that under plausible assumptions, the government-created money stock will be as large as twice or even 3 times GDP. And of course, that does mean, as the governor rightly stressed, that a big part of the financial system would no longer operate as it does now. And it would correspondingly be a big transformation of our economies, with the holding of money financing government purposes, not private ones. That obviously creates political issues. It can be technically managed, but it creates big political and also technical and economic issues, because we're talking about a lot of money. Now, fifth, I think it's very important to make clear what the difficulties are with such a system. And obviously, there are difficulties with such a system. And so let me just indicate briefly the main issues that arise. The first one, the one probably which is felt most strongly by central bankers and monetary economists, is that governments will inevitably abuse the new privilege. They will inevitably abuse the new privilege because the history of inflation is the history of government irresponsibility with the management of the monetary system. And that is clearly true. The private sector is irresponsible with money and governments are irresponsible with money. Like many great inventions, and money is among the greatest invention in the history of humanity, it is a two-edged sword. Without money, we would not be what we are, but once we have it, it's a powerful mechanism which can be abused by somebody. So the decision on how much money to create would have to be left to an independent institution, and there are technical questions, as has been mentioned, about how the control mechanisms would operate. But that's not fundamentally different from the current situation in which the central bank governs the terms on which people lend and borrow. So it would essentially be a transference of the current independent central bank model to a different form of monetary issuance. Not so long ago, it was taken for granted that financiers would manipulate interest rates for political reasons. It was assumed that it would be impossible to create independent central banks, but in fact, it turned out to be perfectly possible. And so I personally do believe that a monetary system, a sovereign money system, in which central banks control the issuance of the central bank money, would be politically possible in many countries in which it's possible to have an independent central bank at all, but I could be wrong, of course I could be. The second really important problem with, and it's, I think, a central issue, is that the borderline between banking and non-banking cannot be policed. And that is to say, banking-type arrangements, shadow banks broadly defined, as the governor stressed, would emerge and create monetary instability elsewhere in the system. And I think that is an absolutely core problem with this sort of arrangement. There are a whole host of different proposals out there of how to deal with this, regulatory proposals that affect the sort of assets that financial institutions will be allowed to hold, and the sorts of promises that financial institutions will be allowed to make. For instance, their promises to redeem liabilities at par would have to be made, I think, illegal outside the core banking system. But clearly a very big set of questions would arise on whether you could prevent banking-type structures of emerging outside the banking sector. Now, part of the answer to this might be, well, let's suppose such structures would emerge. Nonetheless, the banking sector would be the core of the financial system, the monetary system. You might be able to take a more relaxed view than we do at present to the collapse of the shadow banking system if the banking sector pure and simply was absolutely stable, and if so, the moral hazard problem might be diminished. But this is, I think, an absolutely fundamental issue. There is one further point that I would like to make on this, which is if it is impossible to police the borderline between banking and non-banking, as is suggested by critics of these proposals, the new regulatory structure is also likely to fail, since essentially it does rest in fundamental ways on the assumption that we can make this distinction and that we can make banks safe without turning the regulatory mechanism in full on every aspect of the shadow banking system. But this is a very big set of questions about how you could police the border. A third big problem, as already mentioned, is, and I'm coming towards the end, don't worry, is that it would be impossible to do standard monetary policy, and it is clear that, seems to me anyway, that monetary policy would indeed become quantitative. It would be the quantitative theory of money, as Governor has suggested. The central bank would no longer be a lender of last resort to banks, so setting the price of its reserves would no longer be the way monetary policy would work. Of course, it might choose to be a lender of last resort to non-banks, and this comes back to the issue of shadow banking and how you would deal with it in a sovereign monetary system. And of course, in that case, the central bank's emergency lending rate could influence interest rates in the rest of the system. But at the core, this proposal implies a quantitative mechanism rather than a price mechanism for monetary policy. And the final objection, and probably the most, or perhaps the last two, the most important, is we would lose valuable financial intermediation. Banks do very valuable financial intermediation, it will be argued. If the shadow financial system, the rest of the financial system, did not emerge to provide valuable financial intermediation, we would have very, very big problems. I'm less persuaded of this than I would have been before, because it seems to me such a vast part of the financial intermediation process at the moment is of rather dubious benefit, and the most valuable parts of it, venture capital, equity funding and so forth, would operate perfectly well without it. Furthermore, I think a system in which we would reduce substantially the volume of debt in the system, particularly short-term debt, would not lose us very much in terms of valuable intermediation. But as has also been mentioned, the central bank or the authorities could emerge as lenders in the system if they wanted to be, to promote intermediation. That creates its own problems, but it would allow intermediation to continue. And finally, what does seem to me the biggest issue here, we would indeed lose flexible accommodation. This is a point Charles Goodhart, very distinguished monetary economist, makes. The supply of flexible bank credit is an alternative to investing in large holdings of money. If there will be no flexible bank credit and the rest of the banking system didn't create flexible credit in some other way, people would have to invest in large money holdings. That would impose a real cost on business because this flexibility would be lost. Companies and individuals would have to hold excess money against crises, and you would have to find some arrangement to get around that problem, which I think is a genuine one. So finally, let me conclude with where we are. In practice, I think Big Bang reform is now unlikely. It's too late. We are at the stage where we're discussing reforms for what we will do after the next crisis. The next crisis is certain, so planning for what we will do after that, so we're not quite so surprised, is a very, very sensible way to proceed. And all these options need to be thoroughly explored and worked out. And I agree, some countries should try them. I prefer Iceland, but if I could persuade the British authorities, I will be delighted. We could, however, at least make a transition to a part of this by simply saying that all current reserves of the banking system are permanent, in which case we've already raised reserve requirements to about a quarter in the developed varies by, we would have reserved requirements very, very substantially, and there will be a permanent feature of monetary control, and I think they would be highly desirable. They could also operate as a tax on banking, which I actually think would also be quite desirable. Furthermore, I think that it is perfectly possible to imagine that we're going to move to helicopter money, that is to say direct financing of government in some countries. Japan is the most obvious example, and that could also be used as a basis through the back door to get to these ideas. Essentially, you would end up with a sovereign money system even if you never planned it. But I think the crucial thing now is to prepare properly worked out schemes which deal with all the problems I've mentioned, which start from the fundamental point I tried to make in this presentation, which is what we have doesn't work, what we are trying to do through reform won't work, and when that becomes obvious, as it will in the next huge crisis, we better have properly worked out schemes to cover this, and sovereign money is clearly going to have to be one of them. Thank you for listening.
Thank you very much, Martin, for your insight. Now I'd like to invite the speakers to the panel here, and as well as our two additional guests. Ásgeir Jónsson, he's an associate professor and head of the Faculty of Economics at the University of Iceland, and Frosti Sigur Jónsson, MP and head of Alþingis Committee of Economic and Trade. Frosti wrote the report, Monetary Reform and Better Monetary System for Iceland, which has been mentioned here earlier. So if you would like to take stand here, all of you.
Nope. I can share with Mark, okay.
Okay, I'd like to start with our panelists who have not already spoken. Ásgeir, a little bird told me that you've taken the idea of sovereign money with a grain of salt. I'm not going to put the word in your mouth, but it would be interesting to hear your thoughts based on what we have heard from the speakers today. And I'll ask you to share with us your take on the sovereign money system and comment on our speaker's presentation, if you like.
Well, thank you. First of all, I want to say that I actually like fundamental discussions. So I think that Frosti has done a very actually useful job. He has been the main leader of this discussion, and he actually last year, or was it actually the year before, he published a report, which I do not totally actually agree on, but I really like to see politicians have their own ideas, like Frosti has. First of all, there are a couple of points that I want to make. First of all, with the question of sovereign money, first of all, I see there is a great focus on actually deposits, or the old type of money, where people put more money in the bank. And for most regular people, that's the banks that people know. But it's quite clear that the last financial boom was not created by deposit creation. It was a bond-financed bubble. Lehman Brothers did not have any deposits. And in a way, and I've never seen that point really made, that the deposit creation was the main reason for the financial boom. But it's quite clear that the fact that many institutions had deposits gave them an implicit government guarantee, which enabled them to issue bonds at a very low price, or a very low rate, as for the Icelandic banks. first of all. And secondly, as I've also heard, the main problem is now in Europe is that banks are not creating deposits. Hence, we do not have growth. Hence, all the efforts of the euro area banks or the euro area governments has to be to increase deposit creation. So, and in most gatherings that I have attended, I hear usually long talks, like Martin Wolf gave, of the problems of the current financial sector, of the banks. But then we are discussing solutions which I don't really think that is addressing the problems at all. You will also have to think that if the financial system is a social construction, that is correct, but it's also driven by technology. That has been the main driver and is still ongoing. And now I see that we are seeing a major technological changes in how banking is done or how the payment system is operated. In a way, the payment system will be done, or some people talk of a liberalization of the payment system. That you have now they are actually proposing a payment system for Africa, which is just mobile phones. We are also seeing cryptocurrencies. And people are talking that the monopoly of central banks to create money will probably be out very soon, which I think is correct. Banks, as you know them, are becoming kind of obsolete. They are facing a competition from many other sources, from central banks, but also other technology companies. And you also have to keep in mind that the majority transformation, which is the key to the capitalist system, I don't foresee that you can have a capitalist system without a majority transformation. Because you have the fact that companies need funding that has an equal lifetime as their capital or their machines that they're using. Same goes for the household. They need long-term financing or their housing, which goes along with their working lives. At the same time, no one wants to commit funds for a very long time. So that's the alchemy that both Mervyn King and Már Guðmundsson have mentioned before. The banks have this solution, which is a contradiction in itself, and that creates the problem. But majority transformation can be done. Oops, I'm always fell off the stage. Majority transformation can be done by many other means than deposit creation. The deposit creation is kind of the old way of doing it. We have many other. Banks can create liquidity with many other means. So, I myself, I do favor narrow banking. I do think it creates problems of having the payment system and the same institutions handling the payment system and granting loans, but I don't really see a proposal which basically is that calls for the central bank to take over the payment system, to take over the creation of deposits as being kind of a solution, although it's a very interesting theoretical discussion in a way. And as you see, so to just finish this, as I see the finance system is driven by actually technology, which will lead us to both opportunities and risks, quite many of which we don't really foresee now. Yes, so by this spoken, I guess that Frosti.
Thank you. Frosti, you have publicly and actively supported the sovereign money systems for a few years now. Will you reflect on the speaker's remarks today?
Yes, thank you very much, and I thank everybody for being here, and also thank the Prime Minister for hosting this along with KPMG, and I'm very grateful for Martin for coming over here and giving us a very stimulating talk. I'm also grateful for Már for being here, the Governor of the Central Bank of Iceland, for his raising of questions, which I must also point out to him are all answered in my pamphlet on page 89. And where obviously these are very fundamental questions. Will banks be able to do maturity transformations? Who will be lending money? All of these basic questions are answered in this pamphlet, which is freely available. And I encourage everybody to read, because when I started looking at what caused the last crisis, I understood that it was not only the monetary system, or only the fact that banks are allowed to create money, but it was a factor that increased the unstableness of the system. And it was very curious that the bank, which was a central bank, which has the responsibility of ensuring financial stability along with price stability, allowed money supply to grow by 20 times in a matter of 15 years. And I still think there is no reason to change that system. My background comes from the software industry. When we see a very failed software system, we try to fix it, and create another one. I've never seen such a failed system as the monetary system. It is a very, very failed system. It has failed 150 times, and I think in 114 countries. And it jumps at you. There is an opportunity for the first people, for the first nation, to create a better one. I would dare you to come up with a system that is equally bad as this one. So it's very easy to fix. And sovereign money is obviously not the solution to every problem on the planet. It is not the solution to everything, but it is a solution to a very big failure, which we could actually reduce easily. I totally disagree with the governor that we should wait for other countries to do this for us. There is a lack of democratic nations that are able to withstand the forces that want to keep the current system, because there are huge incentives in keeping the current system. If you know how to play the system, you can increase inequality, and you can be on the right side of that equation. Obviously, you want to keep the current system. But for politicians who would be interested in perhaps more equality, economists who want more equality in the world, this is an opportunity to move in the right direction. But anyway, I was very impressed by Mr. Wolf's talk, because he was willing to look the problem in the eye and say it's very, very important that we look at fundamental reforms. This may not be the sovereign money may not be the ultimate answer when we start looking at it very seriously. But what I think is very important that we do, and I agree with that. We have to ask ourselves some very basic questions about the systems. Now that we know that banks are at liberty to create what we call money, deposits that can be used to pay taxes and old debts, that came as a surprise to many of the economists learning here at the university and many other universities. They were told that it was the central bank that created money, then it was multiplied by the banks, and so on and so forth. And we were borrowing deposits made by savers. It's not like this. When banks lend money, they create the money. This is a huge power and can be very corrupting. Would it corrupt government any more than it does private individuals? I doubt it. I think there is more oversight and more safety and making sure that, like we have an independent central bank that has a strict oversight, I would trust the central bank to make good decisions about the money supply. And I doubt that the central bank would have decided to multiply it 20 times in 40 years. That would have been a very, very odd decision. Now, there are other problems with the current system, is that the revenue from creating money, 20 billion Icelandic every year, now accrues to private banks. They are now government state banks for the moment. But when I was looking at this, they were private banks. And we need to think about it, is that a just allocation that the banking and the financial system is taking like maybe a quarter of the total profit generated in this economy? I thought banking and finance should be serving the real economy. Make the real economy thrive and not become, you might say, something that extracts profit from this real economy just for providing these simple services. And then have they created the right amount of money? No, they haven't. They've totally abused this privilege of creating money. And we really need to think about this carefully. And I would really agree with if we take this topic seriously. Obviously, it's not the only topic. We also have to think about, do we want banks to be a combination of investment banks and commercial banks? No country has had the guts to separate these two functions. Could Iceland be democratic enough? Could this be an issue, a topic for the next election? What will the next elected candidates say? I'm not going to run again, but I hope some of them will actually fight for this. I'm not going to make a longer speech at the moment, but having been in Parliament, I'm prone to making longer and longer speeches. But thank you for hosting this conference, and I look forward to this discussion.
The ideas of alternative monetary system have been around for many decades and dating at least back to the 30s with the Chicago Plan. Yet no nation has adopted a sovereign monetary system despite of the many benefits the supports claim. Why is that? Maybe you start, Martin?
Well, the short answer to that is if you think at least of the developed countries, my own view is that emerging and developing countries tend to assume by and large that in the areas of, I've had this in my book, in the areas of capitalism, the developed countries sort of know what they're doing. So they tend to have followed the models that they see in the developed countries. And in most of the cases, they inherited from colonial regimes. So they have had no particular reason to change it. In the developed world, serious discussions of the kind that we're now having only follow enormous crises. So in the developed world, there have essentially been two enormous financial crises in the last 80 years, and both of them have led to discussions of this kind. And it's the severity of the crisis that determines the significance of the legislation. So in the US, the crisis of the 30s was followed by a very radical plan, as we all know, to separate retail commercial banking from investment banking, which held for half a century. Very, very powerful piece of legislation, and the Chicago Plan was put forward. There was actually a huge fight over it, but in the end, there wasn't a comparable banking crisis in the UK, so it didn't arise in the same way. And Europe had other problems at the time, if I may say so. But in the end, the banks defeated it. The same thing has happened this time. The crisis was smaller, so the urgency of reform was smaller. The central banks did quite a good job of preventing a depression, and that allowed the discussion to move towards reform of the system rather than reforming the system fairly quickly, and all these ideas quickly began to seem quixotic and extreme. So I'm not at all surprised that it's been very difficult because there are so very few opportunities for fundamental reform. And the second issue, which obviously comes out with this, is there are, as Frosty has mentioned, staggering interests in maintaining the existing system. And third, they are immense. Simply cannot be exaggerated. Incomparably, the most effective and well-funded lobby in the US is the financial lobby, and I've seen the same thing in the UK as a result of the Independent Commission on Banking. I won't go through the details of how the lobbying works, but believe me, it's pretty effective. And they're the only basically, banks are the only businesses whose chief executives and chairmen can get to see the Chancellor whenever they want, whenever. There's no other, except possibly the chairman of BP. I mean, we're talking about that level. And the final thing is, of course, all radical reforms are frightening, and that they'll always be presented as obliterating growth, as if the banking sector, as it is generating lots of growth. we are actually in an unbelievably lousy growth process at the moment, with incredibly low productivity growth, which has been deteriorating even well before the crisis, and the financial sector I don't think is a help. But they always frighten people into saying that if you reform the system, growth will stop, and that's an absolutely consistent thing. These things taken together, I think, explain quite easily why the system has such tremendous inertia.
Thank you. Már, maybe?
Thank you. Let me make maybe 3 points. First of all, regarding radical reform, I shouldn't be misunderstood. I don't think that what has been done so far in terms of the Basel III process and the associated changes is sufficient. It is far from it. It's far from it. And I tend to believe that the capital ratios being proposed there are far too low. And I am very much open to discussing potential structural reforms of many types. We need to look at the structure of the finance industry. We need to look at the incentives. We need to look at the culture, and we need to look at the ethics. And there are not always easy fixes in this. I know that Frosty has written a pamphlet, and it's a good pamphlet, but if we are going to have this discussion saying all the answers are there, then I just say forget that discussion.
Not just answers to your questions.
So I think there are a lot of issues that need to be worked out here in terms of what kind of radical reforms make sense, and where we assess both the potential benefits and risk. And I think that Martin Wolf made an excellent job in pointing out both sides in his talk. Now, the second point I want to make is that Martin Wolf was referring to the proposals of Helvig and Adamanti, saying, okay, we should have a leverage ratio of 3 rather than 20 or 60 as it went before the crisis. And I have to say, I'm very weak. I tend to agree to that up to a great degree. But then it's important to bear in mind, what is the leverage ratio? What is the leverage of the Icelandic banking system? It is just over 4. So basically, we are there. And the big question is, can we stay there? So in that regard, Iceland is not an ideal candidate for introducing these reforms, because in some sense that has been done. I think that the problems revealed in the financial sector during the crisis in Europe in particular, also partly in the US, have not been dealt with. So don't misunderstand me on that point. The third point, okay, we could discuss this monetary control problem. I tend to think that inflation control was not the problem before the crisis. So central banks were able to deliver on the price stability target, and the transmission mechanism worked. Of course, the monetary system is part of the financial system, and when the financial system breaks down, then you have a problem with monetary transmission. That has always been the case, and that is one of the reasons that we need public intervention to fix that. But finally, I want to make this point. I think deep down there are deep issues having to do with finance and financial contracts. That yes, we can design all kinds of systems, but we can't really fully get away from these issues. I mean, there are long-term financial claims, and there are issues how you allocate profits and losses on these claims, and what were the expectations. And there are problems with fixed nominal contracts. There are other radical reforms to deal with that. Nobody has mentioned that. Islamic banking is one. Okay, let's put that in the pot and discuss more kind of equity mutual forms of financial system. And then there are, of course, information problems with these contracts, and sovereign money on its own will not solve that.
Correct.
There is also the question of limited liability. Investment banks used to be run back in the old days as partnerships. So there was skin in the game. People were dealing with their own money, not just other people's money, and et cetera, et cetera, et cetera. So I think it is much more complex than sovereign money. This is fine, a good start, but the book that you need to write is probably like this. So I'll stop here.
Sigurvin, in the articles and the publications you read a lot preparing this report, did you find the answer why no one has adopted this?
Not really, but I think that's pretty much a sociological question, you know, because innovation, for example, in the field of IT is quite straightforward. You just have to convince one person to buy a mobile phone and to spread out into society. To adopt a new system as a monetary system, you have to convince not only the edifice of economists, but also politicians and the general public that this is the way forward. So it's just natural that it takes so long time and so detailed discussions to have some really fundamental change in this field. I feel urged to comment on a couple of Má's speech in his very insightful speech regarding the scope of the report. We didn't cover maturity transformation in the report as it is not part of the money issuance, but it's successfully conducted today by other financial institutions than banks, for example, mutual funds and investment banks. Well, it's not a matter of nationalization of the payment system. Payment providers will be private, but banks will be intermediating transactions, for example. I haven't seen any indication of anything else in my reading. And yeah, the full reserve system is really a bit different than the sovereign money system presented. So that was just an example made in my presentations as well. And then regarding the open economy, we are just describing how money is created virtually in all economies today. Open economy approach, and that discussion is very relevant for monetary policy today. But just looking at the fundamentals of the monetary system, we allow ourselves to skip that, to not have it a book like this, but a 44-page report.
Oscar, any additions on that?
Well, I have actually already, spoken. Well, I just want to add that I think that we've seen for the past 7-8 years, we've seen tremendous printing by the central banks. We've seen so-called QE, quantitative easing, and the balance sheets of the central banks, they have, I think, quadrupled or they actually grown hugely. And I think that the next financial crisis will be caused by publicly printed money printed by the central bank. So it will be a more actually orthodox one. We have not seen any money creation or a very limited money creation by the private banks. And that goes for Iceland also. I actually, I think that the main issue in banking, I mean, banking is the most actually regulated industry you have. And that's both caused by the government guarantee that the banks have implicitly and directly. And I think that one of the biggest issues is that you not necessarily you make banking more safe, but as you make banking more safe for the economy, that banks can fail without taking the economy down. So in that regard, I have actually fondness for narrow banking. I foresee, I would like to see a more like a layering of the banking. It would be banking services for like, average normal people, which would carry a very limited risk, and then you would have other types of banking for corporates and companies. And as I understand the actually British banking reform, so that's the main issue, that the UK government should not guarantee operations that goes outside Britain or concern large entities. In Iceland, that issue was taken care of with the emergency legislation, which basically cut our banking system into two parts, foreign and domestic, that was put into liquidation. But as I said before, I think that we are seeing now a very rapid changes in banking. We've seen artificial intelligence taking over many jobs in the banking sector, and we see a huge level of changing. In my mind, deposit creation, the old style, is kind of a very limited way of looking at how bank credit is created, how liquidity is extended. Although it's the one fundamental thing that we teach in classrooms, actually. Thank you.
Frosti, why haven't we seen this in action?
Well, I think I agree with everything that Martin Wolf pointed out in terms of the fear and also the vested interests, and that we need a much bigger crisis in the general world to consider radical reforms. We did have a really big crisis in Iceland, and that spurred me, for example, to look into these matters. And what I found was really astonishing. And I put into a little pamphlet for everybody to be able to read about it, how this has affected our economy. This pamphlet has been translated to Polish and Japanese and probably Arabic by now. It's being downloaded all over the world. People are writing doctoral theses about what's in here, and I encourage you to read it. It's quite an interesting little story about how a little country went very, very badly wrong, trusting in systems that are completely obsolete and need radical reformation. And we are among the smallest nations, one of the most democratic nations. We can take initiative. We can really change this. We can reform the system. But if we wait for Brussels to do it, the leaders in stagnation and failed currency zones, they are at a totally different point. They still have to face their big crisis, and they are pumping, like Ásgeir pointed out, they're pumping money into the financial system in the vague hope that banks will be able to find borrowers. And borrowers are in Europe are just thinking about how to reduce the debt at the same time. So they're playing into the failure of the current system and growing it bigger. And I agree with Martin Wolf. We're just waiting for the next one to happen. We can't say when it's going to be. It's not going to start in Iceland this time. And we have to be ready to face it. But I think maybe after that crisis we'll see some radical reform in the general system. But I think we have an opportunity to lead the way and start doing this sensibly by discussing, reading thoroughly the little pamphlets, not misconstruing in any way the suggestions and the ideas, and then we can move forward. And that's the way how we fix the system. Look the faults in the eye. We should not be expecting this to solve every problem with the finances. There are many others, and they are very interesting too. There are also, for example, how we do accounting in the central bank. It's totally flawed. There's no account that shows the profits from money creation. The central bank is totally hidden in their accounts. And I've been pointing this out. It is hidden all around the planet. It's not shown. I think in the UK they're showing it. But there are so many things wrong with our economy and our system. There are so many opportunities to fix it, and we should not wait for other bigger economies to do it. They are very busy doing other things, or stuck in all kinds of vested interest and lobbyism, which is pulling it in a totally opposite direction from what the people need and the real economy need. So I'm a little bit pessimistic after being 4 years or 3 years in Parliament, trying to move it forward. The only success so far has been to get people to understand and realize that in theory, the theory is not the same as practice in terms of money creation. Actually, banks can create money out of thin air when they make loans. And that is a big step forward. Now we have to discuss, are we happy with that? Did it work well last time? Do we trust this system for the future? With banks creating money at will, totally out of control, as long as they can find willing borrowers. The reason they have not been expanding the money supply as they did before is that the Icelandic population is no longer a willing borrower. We have changed after the crisis. We said we want to reduce our debts. And when we have that mindset, banks cannot lend us money. We cannot increase the money supply. That's it. That's the only issue. It's also been contracting because we've been writing off debts. This government has used quantitative easing for the public. It used money, which was taken by tax from the banks and fallen estates, and used that to reduce the household debts by billions. This has not been done in other countries. And it worked. Now, we will see the same problems again as soon as Icelandic people are willing to borrow and as soon as Icelandic banks will be allowed to lend abroad. We'll see it again. So, let's change it.
Yes, Frosti says, let's talk it, and that's fine. But we have to acknowledge, we have already changed to a significant degree. And the biggest, it is clear that the problems that we have in the banking system here were both in the international part and in the domestic part. But the problems in the international part of the banking system were much bigger, and that was actually what took them down. And we have introduced, so we have a radically different banking system than we have. We should acknowledge that, with much higher capital levels, much higher liquidity buffers, and more importantly, we have severely restricted, or almost completely restricted, their potential to go into adventures abroad and putting our financial infrastructure at risk at the same time. And it's not completely right that that the banks are not expanding lending at the moment just because there is a lack of demand. There is a lack of demand, but however, we have also introduced regulations like the liquidity cover ratio, etc., that has been binding on them recently. And last winter, the banks were not fully meeting demand for loans, and you could use a system like that to both control credit and money. So let's acknowledge what we have done. Let's understand where we are. The key issue going forward is the following. Yes, we have done this because we have capital controls. We have also introduced a capital special reserve requirement on capital inflows into the bond market. We have stopped that completely. The big question is, will all of this be deemed to be consistent with the European Economic Area Agreement going forward? You are supposed to be able to introduce something of this kind as a kind of a temporary emergency measure. My view is that we will have to have many of these regulations in place permanently, because fractional banking is dangerous. But fractional banking with no safety net to back it up, as we had in the international part of the Icelandic banks, is an accident waiting to happen, and so it is.
Thank you. Martin?
Yes, I would like, if I may, we're getting towards the end of this, I think, so there are some very, very important points that have been raised, and since I've come all this way, I'm going to make them, that I'd like to respond to. There's 4 The first one, I focused, perhaps wrongly, but I thought it was appropriate given the context and the fact that I was following the governor, on the financial aspects of the system and the case for reform. I would stress, because Frost has done so, and I've done so in part, that these are very, very deep political issues. They're about power in our society, who has power. They're about the distribution of income, as has been said. And I regard a situation in which an oligopoly, let's be very clear, it is essentially an oligopoly of institutions, exert such, but through the sheer scale of its balance sheets and the power that gives them, and the resources that gives them, exert such control over our political system as a very profoundly concerning situation. My last column was on democracy and capitalism and the future of both. I happen to be a believer in market competition, but this is not market competition. As I was pointing out at the beginning, this is a publicly guaranteed and supported institution which operates with balance sheets, which, as Adnata Marty tries to point out, are of a completely different order of magnitude from all other businesses in the world. And that gives them immense power. And that is only possible because of the leverage they are allowed to have, and the leverage they're allowed to have is only possible, in my view, because of the state guarantees which continue to exist. So this is a very big political issue, and I commend Sovereign Money in particular for stressing this. Second, is it Oscar? Have I got this name wrong? Yes, sorry. Has raised some very important issues, and they're so important I think I should respond. There are two in particular. The first is how far is maturity transformation an essential attribute of growth? If you look at the financing of innovation and investment in our economies, certainly the major economies I'm familiar with, banks play essentially no important role whatsoever. They are financed by retained earnings, that is by equity to a very, very small degree now. The equity market doesn't raise much money, and by bond markets, which are, of course, maturity matched by definition. So, and the innovation process is financed in large part by venture capital and angel investor. That's the growth part. There are actually also a very important role for government as procurer and therefore as risk taker. Very important government risk taking. The main role of the banking systems in the Western world is to allow people who have no money to own houses. That is the social function of the banking sector as it is now, in large measure. When you go, and that's why housing booms are always associated with banking crises, property booms. And the deep question is that what we want? And if that's what we want, do we need private businesses to provide it? I have a very good friend who's an Australian economist who says, that's something really central banks can do. But anyway, I think the assumption that, which is true, 50 years ago, 100 years ago, maturity transformation was fundamental for growth. I think it's deeply questionable now, really deeply questionable. They do play a role in risk management, CDSs, swaps, though a lot of the risks they manage against are the risks they create themselves, but that's another issue. The third issue that was raised was very important and profound, which is what a technology will do. But I would suggest, and maybe there should be a response, but this is a very, very important issue. Everybody points to social transformation. I believe there is a certain modest inconsistency in what you said, if I may suggest this, which is I perfectly believe that technology is going to transform the payment system. It can't make it worse because in most countries it's incredibly expensive and inefficient. And we should expect, essentially in the modern technological world, instantaneous payments, instantaneous settlement, essentially free. That's how it should operate. And I would expect technology to deliver that fairly soon. And that's important because it will destroy a lot of the profit base of this transaction-oriented system, and I'd like to see that happen, or at least some of it, particularly if this covers foreign exchange transactions, which is a huge part of their profits. But this doesn't, and I think what was said stresses this, it doesn't eliminate banking. It transforms the technological basis of banking, but as long as term transformation continues to exist as a central part of a consolidated institutions, banking continues to exist, and it was suggested it must. So I think the transformation is not going, in that respect, is not going to be technological. Technological change is not itself going to eliminate term transformation. It will only happen if the costs of term transformation to a greater extent internalized in the system rather than borne by the public at large. And I believe, I'm not persuaded, as I've already indicated, that maturity transformation is as important as people now say. I think it is more an opportunity to exploit implicit guarantees of the state. The final point, but that's a really fundamental issue. So don't look to technology, think about maturity transformation and the subsidization of wanton maturity transformation in the system. By the way, I agree, it's not just in banking narrowly defined, it occurs elsewhere, and that links me to the fourth and last point I wanted to make. It is of course true that if as a result of something like these proposals, banking narrowly defined were safe, we would still need a bank financial system. The criterion for success in reform is that the financial system that continued to exist outside it was one in which failure could occur safely. That's essentially what has to be done, as well as provide the genuine investment funds and other needs of an economy. This is difficult to pull off. And if we're not very careful, we could replicate in this new system, the shadow system as it becomes more legitimate, all the problems of the existing system. I believe there that the problems that is mentioned about incentives, equity, and all the rest of it could and would need to be addressed to make sure that this system can fail safely. But I'm reasonably convinced if we had banking and payments separated from that in a credible way, it would be a large step towards allowing safe failure. Without safe failure, we don't have a private financial system, and without a private financial system, we don't have a capitalist economy, and that puts the government on the hook on a simply unbelievable scale, and I think that's something we should surely all agree on is unacceptable.
Martin, we could go on with this discussion for hours, I believe, but we have run out of time. So I want to thank our speakers and our panelists, Ásgeir, Sigurvin, Már, Frosti, Martin. Great thanks to you all. And thank you all for attending this conference. I think we can agree that this is an important discussion, and we hope that our little report will help stimulate that discussion. It will be interesting to watch the discussion both politically and academically in the future. It's interesting both for academics and policymakers, but also for an auditor like me who has not actively studied economics for decades. I'm quite looking forward to see the outcome when Már has locked his specialist in for a week. So, thank you all.
Great pleasure. Thank you. So you're now giving up your role as a politician, returning to private business?
I couldn't win it, so I'm going to join them.
So good seeing you on this occasion.
Great pleasure.
So what will happen when they